Welcome to the Twomey Stock Market Report. I'm James Twomey, and today's Thursday, October 13th, 2022. Well, what a terrific ride the market had today. We saw a tremendous swing from almost 500 down to almost over at close, somewhere around 800 and change, and it was up over 1,000, the Dow that was, at some point today. So we had a spectacular ride in the market. And I guess the first question comes to mind, is this something that we should be either A, buying into this bounce, B, selling into this bounce, or C, doing nothing? Those are really our immediate options. So here at the Twomey Stock Market Report, one of the things we try to emphasize, we do not want to be reactive traders. And it's going to feel, the next couple of days especially, that you're going to want to jump into this market, and we may still, but overall we are short in the market, and we may see those positions close out and get a sell signal, and we may generate a buy signal. But overall, it should be just a bounce in the market. But as you heard me say before, I'm not in the prediction business, so we like to take a look at our fundamentals and technicals to see what's happening. And I think if we do that right now, if we take a bigger view, will determine what is next. So what's driving the market? Short term, fundamentally, has anything changed? We've heard companies like Intel are cutting back on jobs. We've had a couple of other companies say that they're looking at cost increasing. So therefore, they're selling less, but their profits up because they're able to pass along their charges to the customer. Well, at some point, that's going to break. We saw Delta come out. They said we had increased travel. Yes, our costs went up, especially for fuel, but we're able to pass those costs along, and we feel we have a very upward look in the next quarter. So that came out as a bullish sentiment, right? Walgreens kind of followed the same suit. So what we're going to hear going forward, earnings season starts in earnest next week. We're going to start hearing companies saying, hey, yeah, things aren't that great, but we're able to make most of our numbers and we look pretty good. And forward looking, we've adjusted our costs, but we still see a tough road ahead. So companies, they're in business to make their numbers look good, right? So they would get really shellacked if they came out and all of a sudden, surprise, they lost a lot of money or their sales were way off. So they do a good job of predicting. And they've lowered expectations. And those lower expectations, if they meet them, the market's going to say, hey, see, things aren't that bad. But still, less is less, right? So, but anyways, overall, fundamentally, we've still got the war in Ukraine. We've still got energy prices that are going to be going up because in November, we're going to stop the strategic reserve release out of the U.S. Oil reserves. That's going to drive up prices. We've got OPEC cutting 2 million barrels a day out of the circulation. That's going to drive up prices. Russia's pipeline is now shut off, Nord Stream 1 and 2. So we have to rely on other methods to cover that shortfall, which is an amazing amount when you add it all together. But so we've got that still going on. We still have the economy sizzling along from a jobs perspective, but we're having more and more companies, especially the high-tech side, that are abating in their hiring, and some are laying off. So we have to look at, if not much has changed fundamentally, why are we going to get basically minus 300-400 all the way up to 1,000 and settle at 800 in one day? Especially when CPI came out, it was minus 4%. A plus 4% month over month. So it increased. So inflation increased, right? And then year over year, it was, still a higher number. And technically that should say, or fundamentally, I should say, that should tell the market that, one, the Fed will continue to raise rates. And then the next meeting in November probably will do 0.75 versus 0.5 and may continue to raise rates like they said well into next year in the first quarter. So you can look at that from two sides of the coin. You could say, well, if inflation's kind of, even though it was 0.4 was a little bit higher, it wasn't really bad. And maybe the Fed is getting, if they add another 0.75 and maybe another 0.25 or 0.5 in the first of the quarter next year, early early on, they're going to get close to that 5%, 4.5 to 5% that they feel should be the target window to start moderating inflation. And, the market's a predictor. They look out 6 months ahead. So maybe some people will say, well, we're near the bottom. I might as well buy. There's some good buys. And absolutely there are, right? Okay. So fundamentally, we sense there's not much that has drastically changed to see the market bounce like this. So now we want to look at technically. So let's go over some technicals, and I want to go to the charts. All right. Remember we talked about relative strength index, how like we're looking at the SPY, the Dow, the NASDAQ, and the Russell. Over the last several weeks, we said it's been very oversold. 4 weeks ago, we were at 37, 35, 37, 39, respectively, SPY, Dow, NASDAQ, Russell. The following week, high 20s. The following week, high 20s. And then we kind of bounced up into the mid 30s to high 30s, last week close of the market. So you can definitely say, how long can you stay at an oversold? Well, quite some time, obviously, right? The RSI is not a sole predictor, but it's something we want to look at. So we do feel we're on the cusp of being oversold. Any buying is going to bring in a tremendous amount of buyers because of that factor. So we keep that in mind. Advanced decline chart, we go over this every week in our reports. The RSI on that has moved up to 35.5, so it's come up from 28. That's the top line up here, right? Number, you can see where I graded out here. That's when it was, below par in our world, below 30, right? And then if down below here, the red and the black, basically it measures the advance. This is a daily chart of the advances over the declines. And then you can see we've bounced up off a low here, but not drastically a lot. Now we go back into our really slower oscillator, MACD, not the stochastics, and that's down at minus 325. It's not even anywhere near zero, right? Which would start telling us the market's on a rebound. So what is that? So again, I look at this as more of a longer term view. Has anything really changed in one day? No, it's, are we bouncing off a bottom? Probably. And then we looked at our sector table. Now, we usually kind of go from 1 month to 6 month to year to date to get a feel. And we can see the only thing that's been in green is energy. In the last 6 months, everything was in red. If we pull it far to the left, percent change between the open and the change and the 5-day, we see that energy, healthcare, consumer staples, materials. Now, it's kind of interesting because we had a material play. We got stopped out of that early this morning. We had another material play an energy play. 2 went up quite a bit today, and 1 we got stopped out. So kind of I keep saying a tale of two cities. And then we go down here. Financials are up now, and information technology. So the NASDAQ had a great rise today. Financials, the banks are going to start reporting tomorrow. Somebody knows something, I always say. So maybe there's going to be some good numbers coming out of there. But with that said, short term, we're coming up off all this negative red, 5-day, 20-day, 1 month, 6 month, year to date. So this, any particular bounce is going to be a lot of buying, and the lowest and the hardest that get hit will tend to be bought first. That's especially, so that brings us to the NASDAQ, right? All right, so that gives you just the big picture. All right, now what I want to do is go right to our charts because I want to bring up what's going on. And this is important. This is the daily for the SPY. I know it's a busy chart. I'm going to make it a little bit larger. We're going to, scope it here from, early June to present day today. So, last several months, right? And you look at today, we had a tremendous upswing and a big rebound and a lot of volume. This is the green arrow here. So at the candle, the daily candle went from a low of the year all the way up to surpassed the 9 EMA, and then it got repelled by the 14 EMA. So technically what's going on? Well, I look at this right away and I see how we're at a low and we had a bounce. So I'm going to go to the weekly just to make it a little clearer. So this is the weekly S&P chart. Now, if I look at from the high of this year, which was happened to be the year to date, the most recent high in the SPY, and I look at the COVID lows, and that's way back here in April, May. Let's see, we had February, March, April. So we're in the low there of March 16th and the week of March 23rd. If you do a Fibonacci retrace from that low to the high, I don't want to spend the time today going chapter and verse about Fibonacci, so definitely Google it if you're unfamiliar with it, all right? But look at where it happened. We had a retrace to 0.5. It's probably, I got to make this bigger. We have, usually Fibonacci is things in the world cycle, and Fibonacci is a model that tends to have some, very symmetrical meaning. And then the Fibonacci 23%, 38%, 50%, 60, almost 62, 60.1, 76, and then 100%. So what happened? The S&P hit the 50% retracement. And even though we had nothing really changed fundamentally, there was a tremendous short holding out there. We talked about that in the last newsletter about the CBOE numbers, right? Inordinate amount of shorts, number one. Number two, Fibonacci technically. So the algorithms, hedge funds that were short see this 50% retracement. It's a well-known trading number. And they say, well, chances are we may bounce off of the Fibonacci 0.5 retracement or 0.38 or 0.23, whatever you might have. In this particular case, we happen to hit 0.5. So that kicks off. The hedge funds say, let's start buying. Let's start unloading our shorts. And therefore, you have two things happening. You have technical buying, technical, not fundamental, technical. The quantitative side of the automatic buying kicks in. We start buying positions, going long. That drives up the market. As the market rapidly starts moving up immediately, and this happened about 10:30, whatever it was this morning, I was watching it, those algorithms kick in and they just create this buying spree. While that's happening, anybody who is short and that has their stops in, they're going to put stops in around these numbers, they kick off. When a short releases their position, it's as if the market sees it as a buy. So it creates this volume buy scenario, even though you're just giving up your short position, if you will, and you're taking the difference between where you took the short and where you end up selling it, or vice versa, terminology-wise. The market sees that as a volume pickup. It looks at that as more buying. And then all of a sudden, the algorithms even drive even quicker. And you get this rapid move. And that's what they call short selling. So we had two things happen. Technically, you hit a number. The quantitative, technical, not fundamental, comes in and starts buying. It creates more buying. It creates short selling. And then, a short squeeze. And hence, you get this rapid movement up. I'll pull up the NASDAQ, the QQQ that we use for the NASDAQ, and that hit, I don't know if you could see it, 0.618. So we had already gone through the 0.5 and it really didn't bounce off of that, but it hit the 0.618 at the same time the SPY hits 0.5. Bingo, you got both of them kicking off technically to a buy situation. Rapid buying, shorts being sold, the market takes off. All right. What does that all mean? Let's go back to the SPY. We use that in our weekly reports, as you know. Let's get to the SPY. And I'm going to, and that's the weekly. I'm now going to go back to the daily. Where can we go from here? Well, we've crossed above the 9 EMA. That's a very positive situation. We're still within our secondary. Here's the overall track line, the Twomey trend track line. Then a new secondary track line formed, even steeper negative. So we know it's a down market. We haven't even gone 50% or just about 50% between this new further down technical track line, and we're about halfway between the larger engulfing Twomey trend track line for the whole year, right? So what does that tell us? Well, the next stop, it's going to break and get above the 14 EMA. If it gets above that, then we got to start looking, are we going to get to that trend line? And then ultimately the supply line. We talked about that in previous videos and market letters. And then ultimately the 50, we're talking technically because this is a technical bounce of the 50-day line. And we've got quite a bit of activity going on that tells us there is room to grow. And will we hit that is dependent. Now, does that mean we turn around and buy tomorrow? The market could be up another 400 or 500 tomorrow the way this is playing out. We don't have a buy signal. We're going to stay the course. If it does change, we will buy. We don't buy at the bottom. We don't sell at the top, but we try to get into a longer trend, go all in and heavy, and make our bonus money during that trend and get out, right? So I'm going to go to the short side now. Hopefully that explained, the bounce, where we're going. I need confirmation. I need a true buy signal. And if it is, we'll jump in. And then the shorts, this is going to be the same thing. It's just the reverse, right? It came down, it broke through the 9 EMA. Whoops, excuse me. That's the black line here. If I can get it to show up here. There we go. Broke through that. It got repelled at the 14 EMA. And this very steep inside Twomey trend track line for the upward movement. All right. RSI came down to 55 from a high of where was it? We'll go back to that table, but let's see if it's here. Backspace. Let's see. We're talking about this short. It was 61 at the close of Friday. So, 55, that's not too bad. Abated quite a bit, 56, but, still in the a little bit better than oversold territory because it's below 65. 70 is the technically oversold area. My antenna goes up at 65. But anyways, with that said, we haven't got a sell signal yet for our SPY. It's starting to get to the point where we're going to see some of our stops kick off if it continues to drop, and we'll protect our profits because we've had quite a bit of profit from our buy signal down here back on the 29th of August. Mid-August to end of August, and we want to retain those profits, right? So if that comes down a bit and it's confirmed, we'll make the switch, we'll go long, and we'll sell our shorts, and we'll continue to move on. What we need to watch is another aspect is the bond market and the dollar, the value, because globally what's happening is the strong dollar, us raising rates are causing havoc on the bond market overseas. England came out today and they said they may have to extend their bond buying. That's quantitative easing, not quantitative tightening, which we're doing. That's going to exacerbate their inflation, and they're addicted to, and I don't mean this negatively, it's a term, addicted to that. The government over there, as well as over here, over the past how many years, they swoop in and buy up the debt. Well, that's a false way of keeping the market buoyant. Sooner or later, you have to pay the piper. Well, they can't seem to shake it over there. So we're going to look at the bond market. We hit the upper Twomey trend track line, which we've done before. The RSI has been oversold for quite some time. This is the TBT bond, the 20-year short, and yet it didn't even abate down to the 9 EMA yet, but it probably may pull back because there's quite a bit of selling. So profit taking there. People have been in it. We've been in it since mid-August. So there's a lot of profit protection there. People are going to sell if they see the market turn. Now, this green line, which is getting a little deeper in the woods here, in the weeds, but this green line is the U.S. dollar. And you can see every time the dollar has gone up in value, the bonds go up. The short bond side of it. So the yields are going up, the dollar's going up. That's what we've been saying is affecting the overseas market. Well, the dollar has tracked down the last day or two, and we're starting to see the short of the bonds, the yields come down. And that's interesting because if we start seeing the dollar come down in value, the yields will probably also retreat. Lower yields will ease the market tensions. And, we may have a longer run in this bounce. And this bounce would most likely be a bear market rally bounce. It seems inopportune, but since it started mostly off of technical behaviors. We have to let that whole process run out where shorts get rid of their positions. These are large institutions and funds that are really driving the market here. And since we're, a much smaller player, we're going to have to trade it accordingly. So more to come. Would I jump in and buy tomorrow? You can take a risk position. It depends. Let's say you wake up and the market's, up 3 or 4 or 500 points and you feel like you're missing out. Take a small risk position with a tight stop. That's okay. We're recommending to wait until we actually see this all shake out. But it does give, based on what we're seeing today, we do see a sign that this could be a longer bounce. And this is just because of the volume of buying today and the fact there are so many shorts out there. We could get up to this area where the last high was in the SPY 379. We closed today at 367, 368. So another 10 points in the SPY is not out of the question. And if we go up from there, then it'll be probably most likely a stronger breakout. More to come. We'll give you some more information on our technical behavior, and we'll watch that closely. Any alerts, we're alerting our traders real time through emails. So you want to go to TwomeyStocks.com. That's the number 2, M-E, stocks.com. That's the Twomey Stock Market Report. There you'll see the newsletter, our trade tracker, and you'll have an ability to receive trade alerts. You sign up for that. Sign up for it. You'll get all your trade alerts. For the first 30 days, there is zero cost, right? No credit cards taken. We just plug you into the system. You get everything and that we offer, our videos, our training, our alert system, and then our newsletters and our trades real time. I'm James Twomey. This is the Twomey Stock Market Report. Thank you for listening. Have a great day.